Investing your money is a great way to help it grow, but it can be difficult to know what strategies are best. New investors, in particular, may want to find out what strategies they should avoid in order to ensure their investments are successful. This article discusses the investment strategies that new investors should never follow so they can make informed decisions with their money. Investing can be a tricky task, but with proper knowledge and information, it can become much easier. New investors should never adopt the crowd-following mentality as an investment approach. While it may be alluring to invest in a stock or fund that appears to be popular, doing so can result in decisions being based more on hype than on thorough study and analysis. New investors should conduct their own research and base their decisions on their personal financial objectives and risk tolerance. Day trading is another tactic that novice investors ought to avoid. In an effort to generate quick profits, day trading involves purchasing and selling equities during a single trading day. Many new investors simply lack the knowledge, experience, and skills necessary for this strategy. Furthermore, regular trading might result in hefty fees and taxes, which can reduce prospective returns. Last but not least, novice investors should refrain from chasing after hot investments or attempting to time the market. Even for seasoned specialists, trying to forecast when the market will rise or fall is quite challenging. New investors would do better to concentrate on creating a long-term investment strategy that fits their financial objectives and risk tolerance rather than trying to time the market. Diversifying their holdings across a variety of asset types, such as equities, bonds, real estate, and other alternative investments, is one way to do this. Following a hot investment suggestion without conducting adequate research is one of the most frequent errors made by novice investors. Without knowing the foundations of the business or industry, many inexperienced investors are seduced by the buzz and rush to participate in the hottest trend. If the investment proves to be a fraud or a losing business enterprise, this could have devastating consequences. Trying to time the market is another error that novice investors make. Predicting when stock prices will increase and fall, then purchasing or selling in response, is known as market timing. Even seasoned specialists, nevertheless, struggle to consistently meet deadlines. This technique is not recommended for novice investors because it calls for a high level of expertise and experience that they might not yet possess. Last but not least, novice investors sometimes forget to diversify their holdings. Since it spreads investments over several asset classes and businesses, diversification is essential for lowering risk. In times of market or economic crises, improper diversification can lead to large losses. Therefore, based on their risk appetite and financial objectives, new investors should always strive for a well-diversified portfolio that includes a mix of stocks, bonds, cash equivalents, and other assets. Understanding the many investment techniques available and which ones are security use is crucial for beginning investors. There are several dangerous tactics that you must severely avoid. First off, day trading involves individuals buying and selling stocks within a single day in the hopes of generating quick money. However, this tactic necessitates continuous stock market monitoring and, if used incorrectly, can result in substantial losses. Purchasing penny stocks is another dangerous tactic. Penny stocks are companies with modest market capitalizations and share prices under $5. Due to their low price, these investments may appear appealing, but they can be very volatile and vulnerable to manipulation by con artists. Last but not least, novice investors should steer clear of the dangerous investment approach known as leveraging. Leveraging entails borrowing funds from banks or brokers to purchase more shares than one could otherwise afford. Leveraged positions multiply both gains and losses. Although this may boost possible profits, it also raises potential losses. In conclusion, despite the fact that these investment strategies may sound alluring to novice investors looking for quick returns, they carry a high risk of big losses rather than gains. Before investing in any stock or asset class, novice investors should conduct thorough research. They should also, if necessary, contact financial consultants before making any investment decisions. Diversification is one of the most crucial financial tactics for novices. To lower risk, this entails distributing your investments over a variety of asset classes, markets, and sectors. Diversification is a wonderful method to safeguard your portfolio from market downturns and can help you avoid putting all your eggs in one basket. There are a few important guidelines to remember when it comes to the fundamentals of diversity. Aim first for a mix of stocks, bonds, and other assets that are in line with your financial objectives and risk tolerance. If you wish to further diversify your holdings, you should think about making investments in both domestic and foreign markets. Regular portfolio rebalancing is another crucial element. Over time, as certain investments outperform others, your portfolio may become unbalanced, which could raise risk. You can keep a diverse portfolio by periodically, for example, annually, rebalancing and adjusting the weightings of each asset class back to their original targets. First of all, buying penny stocks is a bad idea. While it could be alluring to put money into these cheap stocks in the hopes of becoming rich quick, they are frequently very volatile and come with a larger chance of losing money. Investing should be a long-term strategy rather than a get-rich-quick scheme. It's critical to keep in mind. Second, novice investors should steer clear of day trading. Day trading is risky for novice investors since it entails making numerous trades throughout the day based on market movements. To continuously make profitable transactions, a tremendous amount of information and expertise are needed. Finally, novice investors should stay away from speculative investments like commodities or cryptocurrency. These investment categories are challenging for inexperienced investors to properly traverse since they are so volatile and unpredictable. Instead, it's critical to conduct thorough research on numerous investment possibilities and pick ones that match your financial objectives and level of risk tolerance while also guaranteeing portfolio diversification. One of the biggest errors that new investors make is to forego seeking the advice of financial consultants. Many novice investors think they can handle their investments on their own without professional guidance, which frequently has devastating outcomes. Financial advisors are trustworthy resources when it comes to making wise financial selections since they have professional training and expertise in investment management. Novice investors who want to maximize their earnings without taking on too much risk should seek out financial advisors in particular. Advisors can assist first-time investors in creating a customized investment plan that takes into account their particular requirements and objectives. They can also help novice investors find the best prospects by offering market information. To sum up, novice investors must seek the advice of financial professionals. With the assistance of an advisor, new investors can minimize risks while increasing profits on their assets. Novice investors can make decisions that will lead to long-term success in the financial markets with the correct guidance from an experienced advisor. In conclusion, it is essential for new investors to approach investment strategies with caution and seek professional advice. Rushing into investments blindly can result in devastating financial losses that may take years to recover from. New investors should steer clear of following the herd mentality or investing based on emotions. Investing in something just because it seems popular at the moment is a recipe for disaster. Furthermore, new investors should avoid making decisions based solely on past performance. The market is constantly changing, and what was once a profitable investment may no longer be so. It is crucial to conduct thorough research and analysis before investing in any asset class or security. Lastly, it's important to remember that patience is key when investing. Rome wasn't built in a day, and neither are successful investment portfolios. With discipline and a long-term view, new investors can achieve their financial goals while avoiding the common pitfalls of the risky investment strategies outlined above.